Welcome to a brand new conversation by the Dutch investors. I'm your host Siem, and in today's episode we will talk about holding companies and serial acquirers, a much requested topic by many of our listeners. You will learn how they operate, why they're potentially interesting from an investing standpoint, what the differences are, the KPIs to look for, and so much more. And I won't be doing this alone. No. I'll be talking to Michael Gielkens from Tresor Capital. He's a fund manager and an analyst focusing mostly, but not exclusively, on holding companies and serial acquirers, and he knows all about them. I'm sure you'll enjoy today's episode as much as I did making it. So let's jump into today's conversation with Michael Gielkens. Welcome, Michael. We just spoke before the recording a little bit. We just met as well. So, how are you doing today? Is the weather as nice as it is here?
Yeah, it's good. We're happy that the air conditioning in the office is working again. So that was problematic earlier this week, but so far the climate's good and everything's going well. So looking forward to doing the podcast.
It's good to have you on the show. You're actually one of the most requested guests so far. It's probably due to our quite large Dutch following as well. But yeah, lots of investors wanted to hear from you and learn about investing, specifically holding companies and serial acquirers. I got a lot of questions about them. So yeah, thanks for taking the time out of your day to do this. I know you really wanted to go to the beach today, so thanks. For those unfamiliar with the concepts, maybe you can briefly explain what they are and why they are different from, let's say, call it a regular company.
Well, they're investment companies. So the main role of these firms is to invest and reinvest capital into the highest return potential opportunities that they can find. So. For example, if you have a serial acquirer, the cash flows can be reinvested. So basically, the returns as a shareholder that you can make are a function of the reinvestment rate and the return on those investments that they are making.
Isn't that something all companies should do? Allocate capital to the best of their ability?
Yes, but it's very few companies that are actually able to do it well.
Fair point. So how did you end up specializing in serial acquirers and holding companies? Why those two specifically?
Well, when I started out in this business a few years ago, there was a strategy investing in just all kinds of different active funds and a few individual companies. And one of my first jobs was find which companies have been able to get the outperformance or have been able to actually get the good performance that we've been generating. And Berkshire Hathaway and Investor AB, two holding companies, were the standouts. And most of the active fund managers, surprise, didn't meet the benchmark returns that we were looking for. And meanwhile, Berkshire and Investor AB were quite easily outperforming since they were bought at, let's say, 2010, 2012 for some clients, even before. So that was a bit of an eye opener professionally. And one of my colleagues, he actually got me into this business, and I was in an investment club with him when I was still a student. And he was talking about Berkshire Hathaway and Warren Buffett, and that kind of got me on the track to that laid the foundation, if you will, to learn and study more about these kind of companies. So Berkshire was actually the first stock that I bought in my dad's portfolio still. So we bought it together, if you will, and Investor B was one of the first as well, and the fascination kind of started there already with investing in all kinds of companies. And you think, hey, I should buy different kinds of stocks. So you're buying banks. So I bought some shares of SNS, which wasn't so successful over the long run, and then gradually you're making some early mistakes, if you will. and you're gravitating towards the strategies that have worked out, and you're starting to study why were these companies able to get these kind of performances. And yeah, that's a function of a few of the things that are now the core of our investment strategy.
All right, so let's talk about the serial acquire playbook. I believe you're the founder of Tresor Capital, correct?
One of the co-founders. So we're with four partner shareholders, where we co-own the company.
Yeah. Is the investment fund focused mostly on holdings and serial acquirers, or is that just your preference and specialty? Or
No, so it's actually this managed accounts. But we're actually looking at maybe launching a fund, investigating that as we speak. No, it's I would say for clients with an equity exposure, it's either the full exposure or over 75% of their portfolios with us. So in our model portfolios, especially clients with a more you could say offensive profile, they are looking at close to 80% allocation towards these kind of companies, so that we manage it as a separately managed strategy, and we're also tracking the performance against the benchmark, where we have a monthly fact sheet, which we provide for clients.
okay, I see. That's exciting. So let's say you're looking for a serial acquirer. You've read a couple books. You saw the success of companies like Constellation Software, Topicus, maybe even Berkshire Hathaway at the beginning, and you want to find one yourself. How do you typically look for these serial acquirers? Do you just stumble upon them or screen for them? Can you tell us a bit about that?
Well, it's screening can work, but it's hard to model. There are very different business models in terms of acquisitions, but I know there are screeners where they show like cash acquisitions or something like that. So that could be an indication. But then a lot of companies do acquisitions, so that's not a screener option per se. No, it's mostly yeah, looking in different networks, if you will. So I'm very active on X, Twitter, active in communities, going to conferences, and communicating with other investors. So that automatically helps you find interesting opportunities, or you help others find interesting opportunities. But it's to some extent, yeah, is it screenable? I mean, insider ownership might be screenable. Return on invested capital could be screenable. Valuation, or let's say the balance sheet strength, EV/EBITDA, could be screenable. So these are things that you could find in a screener, but it's also a lot of just, yeah, working, uh, turning over a lot of stones, and uh, after a while you develop, I would say, a sort of a radar for things that you're looking for, and you can very quickly say no to some ideas or to some companies, or very low insider ownership is almost automatically one of our points. We want to have a significant skin in the game for a company, so that's an important variable. A consistency in earnings. You don't want to have very very high levels of cyclicality if you're running a portfolio. Strong balance sheet is very important for us. So maximum level, I would say, of 2.5 to 3 times operating profit in leverage, and yeah, high return on invested capital. So ideally, over 15%. That's a metric that we also screen for. So let's say we have a database of around 500 companies, either holding companies or serial acquirers. What we basically see is, if we apply these variables and if we apply our metrics that we're looking for, automatically we're already losing between 80 to 90% of the entire universe. So it's like what Bessenbinder finds with his studies, that a handful of companies generates the outperformance in the long run. We've also seen that companies that don't meet these criteria oftentimes aren't able to get the return metrics that we are looking for.
Yeah, he talked about the 4%, right? Yeah, the communities and talking to other investors is such a good piece of advice. We just launched our community, and we talked to this Swedish investor who mentioned a Swedish serial acquirer of private schools in Sweden. Apparently, that's a pretty big thing there. It's tiny but highly profitable. Just if you look at the figures. So yeah, that is a good way of finding ideas. So let's say you find an interesting serial acquirer. Where do you start? What does your research process look like when you analyze one?
So yeah, finding these four or five attributes that we that I just mentioned, that's very important for us. Ideally, you want to have a founder, owner, operator, or a large, let's say, reference shareholder or family as a partner. And then we're starting to see what are the end markets, what are the exposures in terms of where are their economic profits coming from actually, so geographically or industries or stuff like that, and just seeing is there a kind of a moat with this company, is the management doing the right things, how's management turnover. These are some early things that we're looking at, that we're screening for, that we try to get a sense of. Is there a good write-up available from an, ideally a fundamental quality style investor, that who are, if it's a US company or in general, who are our partners in the shares, so who are the top 5 or top 10 individual shareholders. All these kind of things can tell you something about other people who already did the work, for instance, or yeah, what are some things to look for. And then you're just gradually digging deeper, and layer after layer, basically, if they survive the 80 to 90% shift at the start, then you might be looking at a diamond in the rough that deserves some further polishing.
So to invert that question, if you're looking into the businesses, are there any I don't like the word red flag, but are there any red flags or any things you don't want to see in a serial acquirer specifically that just makes you want to leave it and just go on to the next?
Well, one thing is if you have a serial acquirer that takes on significant amounts of leverage to do acquisitions, in especially in a time when interest rates are low. I think REQ Capital did a study on that, on serial acquirers, where they showed that there were a few companies that that they did a case study on, that had significant leverage to buy, let's say, low quality companies at any price. The best example, I think, is Storskogen. Frederick Carlson, the former Lifco CEO, currently the CEO of Roco, he basically said, if you there are only so many companies that you can buy of low quality with no moat at any price with high leverage. There's only so long that can be successful, and at some point, fundamentals are going to be driving the business, the quality of the earnings, the mode of these companies, will be very significant. So companies with a high amount of cyclicality, that's something I would yeah, that we don't like to invest in. There's also different styles of management. For instance, a new CEO comes along, and a few years ago, I think last year, Investor AB had a switch in CEO. Yeah, that can also be a trigger. How does the new management team run the company? And yeah, the CEO that left the company had a very high amount of skin in the game, 30 years or 25 plus years with the company. And then the new guy, Christian Sederholm, comes in. He's also 20 years with the company, and has a similar amount of skin in the game already as the CEO that's leaving the company. So it's not like there's a rookie taking over the reins. He knows the company extremely well. Has been working with the non-listed serial acquisition group of companies with Investor AB from Patricia Industries, and now he's the CEO of the whole enterprise. So that gives a very that's potentially a green flag, or at least not a potential red flag. But if someone from outside is hired, we used to be investors in Alberts, a Dutch company, They were run by Jan Alberts, founder. Then you had Pelsma, who was the chief operating officer appointed by Jan Alberts. And then at some point he left. And instead of finding an internal hire, they hired a French CEO from outside of the company. Nothing against French people, but we prefer to have someone from the inside being promoted. So a combination of that plus that the company was reaching our fair value close to 50 euros, that was just a reason for us to sell the position last year, and to find other opportunity to invest in other opportunities where the mode or the quality of the business were a bit higher, and no skin in the game and management level. That's the biggest red flag in our view. We've seen a few things like there's a serial acquirer in Australia that's buying accounting companies where the CEO is always talking about Warren Buffett at every single chance he gets. At some point, that you could say it's communication to attract the type of shareholders that you're looking for. You could also say, well, at some point, you're trying to borrow the name and attach it to your company. There's a Swedish serial acquirer where I think that they had 4 CFO changes in about 2 years' time. That's a very significant red flag in my book. So these are things to look for, to avoid. Yeah.
Or to avoid, yeah, rather. Yeah, yeah, yeah. Why is it that Sweden is so successful in with serial acquirers? It seems like the country is punching way above its weight. Technion, Livco, Attack, maybe Lagerkrans, Instalco. Why is that, you think?
Well, Sweden has a very interesting and a very unique dynamic in the country. So on the one hand, I would say it's a very pro-business economy. We're going to publish something that was a deep dive in our newsletter a few weeks ago about Sweden as a is it the new Silicon or is it the Silicon Valley of Europe, basically, where you can see there's a deep capital market, there is a pro-business government, there are pro-business regulations, there is for instance, for smaller shareholders, there's a very high active ownership amongst small private investors, whereas in other countries, I would say, without becoming too political, investors are seen as the cash cow to fund the government deficits, if you will. Versus in Sweden, where they say no, it's a very good way to build up your pension, if you will. So a few weeks ago, there was an interesting documentary on Bloomberg Wall Street Week, where the CEO of Investor AB was actually one of the guests, and we also highlighted that in our deep dive, where he names a few things why Sweden particularly is maybe a breeding ground of successful businesses and economic growth, and particularly the serial acquisition model. I would say because of this positive economic dynamic, but also Swedish culture. It's very pro-business, very open-minded. There are some big families like the Wallenbergs that are, you could say, long-term stewards of capital. So there's automatically a bit of a longer-term investment horizon embedded in the culture as well. And Sweden is a very small country. So at some point you've exhausted your home market and you're automatically looking for international markets. So is that are you going to do that organically, or are you going to do that through acquisitions? And I think Bergman and Beving started the model in Sweden with buying other companies and then spinning off Attack and Lagerkrans, and Attack again spinning off AdLife. So there's you could say, kind of a Matryoshka, a doll situation in terms of structure. So it's been successful, and then it automatically attracts other businesses where they say, hey, we have excess capital, what can we do with that? Well, instead of paying a dividend, we could also reinvest it in other companies. And so the companies like Livco or Indutrade were inspired by that as well.
Yeah, that's a good point. I hadn't thought about that. If you have a small country based on the amount of people you have, you kind of have to focus internationally, and acquiring businesses is one way to do so. I didn't think about that one. So a lot of people confuse maybe serial acquirers with companies doing M&A. Most acquisitions fail if you look at mergers and acquisitions. When is someone like truly a serial acquirer? Because you could argue, and I'm going out on a bit of a limb here, but I guess that once you become large enough, like Berkshire Hathaway, Constellation Software, maybe even LVMH, it could also be considered a holding company, but also like a serial acquirer, maybe. These models are built around acquiring, holding, and operating a decentralized portfolio of companies, right? So, is there some overlap there? What's your take?
Yeah, we started out with investment companies. So there's a slide that you might know where you basically go from a high level of integration to a very low level of integration, where you have roll-ups, platforms, accumulators, and holding companies. I could share it, and you could maybe add it to the show notes, or we add it on X or something. But it's a very interesting, yeah, it's a very interesting way of where you basically see what's the strategy of the company and what's the level of integration. And basically, if you have a very high level of integration, you're basically a roll-up buying companies in a similar industry. So, for instance, think about well, you could think about Kelly Partners Group buying these accounting companies, or Waste Management buying waste companies in local markets. It's an acquirer of markets where the focus is more, you could say, on synergies, one industry, and scale advantages. Where on the complete other end of the spectrum, you have the holding company, where there is no level of integration, where there are many different levels of um, sectors, industries, listed private companies, you name it. It's very so like a Berkshire Hathaway, like an Investor AB, where you have a very different level of strategy. And then in between, you could say you have the likes of Livco or AdTech, these kind of companies, where you have acquisitions in different end markets. So Livco has two dedicated platforms in dental industry and demolition and tools. And then you have the let's say system solutions, which is basically a hodgepodge of different end markets, uh, where you could say, well, you could say the dental division is a roll-up of dental companies, but then system solutions is it's more of a platform of different different end markets altogether. So you could say you can distinguish it in the matter of integration, in the matter of where you're looking at synergies. But to distinguish holding companies and serial acquirers from, let's say, the sporadic M&A, because all acquisitions, we have been taught, destroy value. You might be familiar with a very interesting study by McKinsey, where they say there's a small subset of companies that do regular acquisitions, where acquisitions are actually the business model. So, to what level is that an LVMH or a Berkshire Hathaway? They did more acquisitions a decade or 2 decades ago than the past years, if you will. And then you have companies that are buying 100 companies a year. So that's the typical serial acquirer, if you will, like a Constellation Software, where your acquisitions really are your business model. So these, they call it programmatic M&A. So if you do a lot of deals and a lot of small deals, particularly, then acquisitions really become an acquired skill, and that's and maybe even a competitive advantage, because of course, when once you have done you've bought 100 companies or even 1,000 companies, then you have a playbook of what to look for, how to buy these companies, and so it's very different from buying a very having a very large merger of equals, for instance, when you have two different corporate cultures, two different ERP systems, two different accounting systems, and then management's attention is basically for a couple of years focused on integrating these companies, and it might actually not be successful. So you've seen, I think, the Warner Brothers Discovery merger, where they're now untangling everything again. So now they're doing a demerger again because they weren't able to combine the companies because it was just such different end markets. So doing these very big deals, that's where the destruction of capital basically comes from. And doing a lot of these smaller deals that can actually generate a statistically significant level of alpha.
I'd like to ask you a question surrounding a goodwill. I think most investors know that goodwill is usually intangible, the premium paid over book value for things like brand, customer relationships, market position, maybe. I guess few realize how much of the asset base it can represent in serial acquirers. Can you maybe just explain to me, as I'm like 12 years old, how to think about goodwill for serial acquirers? Because to add to my question, a couple months ago, I analyzed the company Essilor Luxottica. It's an exceptionally almost under the radar company. It's very large, but most people don't even know they exist. But half, yeah,
Delvecchio.
yeah, Del Vecchio story. It's a great story.
Mm-hmm.
Half of its total assets,
Mm-hmm.
$30 billion, is goodwill. So, what does that tell me or the investor? Is that perhaps a red flag? Is it can it be positive depending on the context? Because goodwill also lowers return on invested capital, and it's one of the KPIs you looked for. I believe you said that just a few minutes ago. So how do you think about all of that?
So normally you would say a large goodwill component in the balance sheet is a red flag when you're in general analyzing a company. For serial acquirers, I would say it's a bit different. It really depends on your view of can the company get a good return on those investments. And when acquisitions are your business model, then of course you have a large goodwill position, and that translates also through to the earnings figure. So I'm always very cautious to look at price earnings ratios when you're amortizing goodwill. When if it's a good management team with a good acquisition track record, they're not likely to overpay for an acquisition. So then the goodwill that you're activating is the fair market value of the company that they're buying. And then if you're optimizing the companies that you've bought, then you could say that the companies are becoming more valuable instead of less valuable. But you're writing them down because of an arbitrary a goodwill amortization. So that has an impact on the earnings figure. I would say for companies with a good track record, so that's very important. Management teams, that's why we always first look at the partner that we're the management team that we're partnering with. What's their track record of acquisitions? Have they created value or destroyed value? So goodwill in and of itself isn't a problem per se, but if it's resulting from large acquisitions that have questionable incremental returns on that investment, you could take a write down as an investor, for instance, in your analysis of the valuation of the company.
I mean, most sites just give you the ROIC, but I mean, that takes into consideration goodwill as well. I've always learned that you shouldn't take out goodwill in a physical business, but sometimes I guess it can be useful to take out in software businesses. Is that something you do, or usually you just leave it there?
Now, usually goodwill, because goodwill is the invested capital. So those are the companies that you've bought. So you should be able to get a good return on those investments unless you are overpaying or something. So um, I would say usually goodwill is I wouldn't exclude goodwill from the return on invested capital. What is interesting, what the Swedish serial acquirers do is they look at the return on working capital, which is a bit of a Berkman and Beving metric. They've coined the use of that. So that basically shows how efficient the company is with their working capital. That can also be an added value, and of course goodwill isn't part of the working capital of a company.
Do you are you familiar with the company Technion?
Yes.
They've been struggling a bit recently, mostly due to worse than expected acquisitions in tougher industries in the past. The new ones appear to be a lot more profitable and to be better. We've talked a bit about the model behind them, behind serial acquirers, but let's say you're looking under the hood of these serial acquirers and you're trying to understand what kind of companies they are buying or bought in the past. So how do you assess the quality of the companies they acquire? How can we know or find out as investors whether the acquired companies are any good, or do you just have to trust management here?
Yeah, on the one hand, you have to trust management to some extent because they're running the company on a daily basis, of course. But you're also looking at metrics like organic growth, for instance. So if they're buying companies that have a good level of quality with them, then normally you would say you're also looking at organic growth. But what are their end markets, for instance? What's the business model? So, if I recall correctly, Technion has bought, I think it were a bit of their part of their early acquisitions that were a bit more cyclical,
Yeah, the home builders and stuff.
and in nature, and so that kind of comes back to bite you in the ass, if you will. If I can say that on the podcast, otherwise you can edit it out. But
Of course you can.
so that's the thing. But discussions with management are important there as well. Normally, if a company has an earnings call or has a letter to shareholders or has a annual general meeting like a Berkshire Hathaway or a Constellation, where you can ask questions for a while. Then you can get a sense of these companies. But that also follows from uh, uh, building up some experience with the companies, right? So you know more about Berkshire after owning it for 10 years than you did when you first started looking at it. So it's also a bit of a skill, and it also becomes a part of your skill set, part of your tool set, if you will, when you've been following these companies for over 5 to 10 years.
Yeah, you're just adding more context and you have more information over time, right? So
Yeah, yeah.
that makes sense. Do you have an opinion on Technion? Or just out of curiosity?
Well, if I can, it's
Be brutally honest.
one of the red flags I just mentioned pertains to Technion. So I think they had a CFO change a few years ago. They had four CFOs in 2 years. So that was a bit problematic. If I recall correctly, Daniel Zhang, who was the chief experience officer at the time, he's quite active, or he used to be quite active on Twitter. And at some point, someone told him like, "Hey, in the quarterly report, your share count went down." So he apparently did a share transaction, and someone said, "Well, you didn't report it." And then the reply was, "Yeah, but chief experience officer isn't a role that needs to be reported to the Swedish authorities." So those were a few things where I was like, is that? I mean, it could be a coincidence, but there was, or at least I would say, yellow flags to look for. So to be honest, in Sweden there are a few of the bigger ones who are still internationally speaking quite small in terms of the opportunity set. So an AdTech or a Lifco are just very small still if you look at an international context. So I would just say I would go for those who, in my opinion, are best in class. Lagercrantz, Indutrade, and Roco are interesting as well. So to be quite honest, I just haven't given Technion that much attention versus those other companies, and you don't want to have 10 Swedish industrial serial acquirers, because then you could better buy an ETF.
It makes sense. I mean, what you're saying is there are so many good opportunities out there, and serial acquirers depend highly on on capable management. So if you just don't have a good feeling with management teams, right, it's probably just better to keep looking. So that makes total sense. And I think they're turning the ship around. I think they are very honest. They stay in close contact with investor relations. That makes sense. Lastly, before we head over to the holding companies, I do have a lot of questions about that as well. Is there anything you'd like to share about the culture or incentives from serial acquirers, or is it pretty similar to like a? Is it just dependent on the type of company you are, what the incentive structure should be? Any thoughts?
Well, I mean, the gold standard is Constellation, right? So uh, mandatory reinvestment of your bonus in the shares on the public market, and not being able to sell them for a couple of years. That's the ultimate gold standard, if you will. But not every company can have a CEO that earns €1 or €0 or dollars of of compensation. So it depends per company. What we typically look for is a certain amount of skin in the game. We prefer to have a large owner of the shares. So a reference shareholder who owns, let's say, 10, 20, 30% of the company. On the one hand, gives him a strong vote as a large shareholder, and yeah, it makes sure that you don't get these opportunists that want to break up the company and get a short-term profit versus long-term value creation. But it also aligns the incentives of management with the external shareholder. So it's kind of a solution to the principal agent problem, if you will. Management teams have their own incentives, basically. So I always like to say, as Charlie Munger said, show me the incentives and I'll show you the outcome. So incentive structure is one of the more important things to look for. And so you want to see a certain level of bonuses being given for return on invested capital. Ideally, you don't want to have a 10% dilution each year in terms of share-based compensation, if you can avoid it. So these are some things that are important that we look for. But it all boils down to skin in the game, and sometimes, especially at the start of the company, yeah, it's not possible for the founder to own 60% of the shares as a block, because he had to invite other shareholders to support the growth of the company. So, or you have a controlling shareholder who appoints a manager like Investor AB. There's in the Wallenberg in the managing board, but they hire extremely skilled managers with a significant amount of skin in the game in terms of their multiple on their annual earnings, for instance, or on their annual income. So there's also a way that you could look at it, like 5 to 10 years of salary, or of your base salary in the shares. That's a different mindset than when you only own options or one or two shares, and when the options vest, immediately selling them versus retaining them. That's like, if you don't believe in the shares of your company, why should we as outside shareholders, right? So that's something that's also very important.
Let's say you have a portfolio of serial acquirers, and the stock market closes for 15 years, and you can only look at two performance metrics, two KPIs. What metrics would you look at to assess whether the company is going in the right direction?
Well, a couple of serial acquirers have a very good metric that approaches the growth of intrinsic value per share. So Constellation and Topicus, for instance, they have free cash flow available to shareholders. Livco also has a metric like free cash flow per share. So that's like after maintenance capex, but before acquisitions. So they say we could pay this out as dividends. We could reinvest this in acquisitions. We could do organic growth with this, so growth capex. So that's basically the number that you can own as a the cash that you it approaches owner earnings, basically what Buffett coined, a term that Buffett coined. That's if a company has that metric, that's very useful. Or otherwise, I would say free cash flow or operating cash flow minus capex per share. That's a very important metric, and return on invested capital. That's just the two important ones. And if I can add one third, and I cheat a little here, it's a reinvestment rate. So basically, how much of your capex can you reinvest, or of your cash flow can you reinvest at that high level of so Swedish companies they have a dividend culture, so they pay 30 to 50% in terms of dividends, and then the rest of the portfolio is reinvested in at least 20 to 25% return metrics, which automatically yields a very interesting. So you could say 1 to 3% dividend yield, and then maybe 12 to 20% yield on cash flow, if you will, which translates to your return, and then you of course have the final component, which is the market value or the market valuation. But that doesn't exist when the market closes for 15 years, so that wasn't part of the equation.
Yeah, you're cheating a little bit here, but I don't know if you've read this book, Buffett and Munger Unscripted. You have?
No, I've still got it on my list. I think Alex Morris published it earlier this year.
Yeah, I gotta give it to him. It is one of my. I know it is his book, but most of the information is from Buffett and Munger, right? I mean, he just distilled 30 years of gold nuggets from Buffett and Munger and listed them by topic. So I just I'm reading it for the second time now, and I yesterday I was reading on incentives, and if you just hear them talk about how simple it should be, they only grabbed a napkin, talked to the CEOs, wrote down a little equation of how they want their business to perform and what metric they'll track, and that's it. He never thought about it longer than 5 minutes, he keeps saying. And some of these incentive structures seem so complicated, and it's a great book. I highly recommend people to read the book and buy the book. I'm not sponsored by him, just my honest opinion. Yeah, that was Serial Acquirers. Are you still down to do the holding company section, or are you falling asleep already?
No. I could do this for a few hours, so no worries for me.
Oh, okay. Good to know. Good to know.
I always say just drop in a quarter like a vending machine, and I'll just keep talking until you unplug me, basically.
All right, let's talk about holding companies. Can you briefly explain what is a holding company? How do they make money?
So it's basically just a stock like any other, but the business model is basically investing the balance sheet of the company. So to some extent similar to serial acquirers, but in a different way. So they're completely unconstrained, typically in terms of, are you buying stocks of listed companies? Are you investing in private equity? Are you investing in direct ownership of private companies? Some companies have a lot of bonds, gold even on the balance sheet. So it's truly unconstrained. You could basically call it a listed family office. So it's just like when it's a family running the company. It's basically just a way for them to manage their wealth, and you are able to tag along at very low ETF-like fees for running the holding company.
Is investing in a holding company basically saying, you do the work for me? I trust that you can reinvest my money basically in good businesses, or is that too simple?
Well, it's that's the essence of it, but doing that very well is also a challenge. So there are a lot of holding companies that actually destroy value versus create. I mean, partnering with an owner operator or partnering with a family uh, sounds like the ideal thing to do, right? I mean, you're just hiring the manager, and then he will buy companies, and you're basically subcontracting your capital allocation to the management team of the holding company. But then they also have to do it well. So
How do holding companies do it well? What makes? I mean, they come in all shapes and sizes, from Berkshire Hathaway to very small industrial companies, holding companies. What makes a good holding structure work?
a very long-term focus. That's key. If you're trying to optimize on a quarterly basis, then that's not going to work. So often they are actually counter-cyclical. So when public markets are priced for perfection, they prefer to stay in cash or just buy private companies. But yeah, also I would say having low levels of debt that creates optionality. So oftentimes you have a bit of a lazy balance sheet, if you will. But yeah, you could also view that as optionality for when the market drops significantly. You could actually buy companies that you own or new companies at a lower price. I would say diversification to some extent is important. That's you could say counterintuitive because some of the best investors run concentrated portfolios, and on the other hand, there are very few companies that have been in the portfolio for over 5 to 10 years. Even for Berkshire Hathaway, if you look at their listed companies, so it's like Coca-Cola or American Express. But yeah, some companies have been bought and sold like a Disney in the past or these kind of firms. So we prefer companies with a bit of a diversification between asset classes as well. So public and private companies. You could buy the public companies yourself, but the private companies you can only buy when investing in the holding company. So that's also an interesting distinguishing factor of these structures. But it's also just having a controlling shareholder, which makes sure that you're looking at the longer term in terms of strategy, in terms of stability. Counterintuitively, they're also dynamic. So normally you would say if there's a controlling shareholder, it's a very boring company, but they're actually very dynamic in terms of investing through the market cycle, being active when ready to pounce when the opportunity when opportunity presents itself. Yeah, basically you're buying an actively managed ETF at ETF costs, but partnering with an owner operator in most cases. So doing it well is well, I mean, the ultimate uh, uh, metric is net asset value growth per share, right? So a lot of these holding companies publish an intrinsic value per share, and they just show the growth through time. And I believe Investor AB has been able to grow it over 12% for over 100 years. So then in the end, you're also making that on the longer term, the stock price approaches the growth of the intrinsic value per share. So investors have also made over 12% CAGR investing in those shares since 1919.
Yeah, I wasn't around back then, so I wouldn't know. But
Me neither, by the way. So
oh, okay. uh, Lots of these companies talk about decentralization. Is that a requirement for a holding company, or is it just one way of running it? Or
yeah, to be honest, I don't know of a holding company where a centralized structure has been very successful. I mean, to some extent, every holding company is by definition decentralized because Warren Buffett isn't going to run See's Candies, and Mark Leonard isn't going to go to a German local golf software company to tell them how to code the tea times into the software package, right? I mean, on the holding company level, by definition, your primary role is allocating the capital and allocating it wisely. You could have a centralized role in that respect. So Berkshire Hathaway is the role. Uh, until not that long ago, you had two guys in their 90s who were just sitting in an office in Omaha with 20 people around them, and they were just looking at interesting opportunities, buying companies, or not doing anything at all. And that was the role at the holding company level. Um, and you also have companies that are a bit more hands-on. So you could say, for instance, Constellation has the best practice sharing on a quarterly basis on the board level. They try to look at investment cases where a VMS company, vertical market software company, went wrong. or one that's doing it extremely well, and what can we learn from that, and can we share those learnings with our subsidiaries? So then you're giving your portfolio companies a toolbox, if you will, on how to optimize. And Investor AB, for instance, has an active role through the board of directors. So they're not running the companies directly from the management board, but through the board of directors, they try to help them in terms of strategy, in terms of they call it future proofing. So, for instance, very early on, they were looking at how can we make these companies, how can we be a leader in terms of AI and digitization versus being a laggard and being competed away? How can we be a best in class company in the industry? And that's a very clear thing that they are steering on, and where they have very high quality demands from the companies. So that's I would say a bit more hands on, but yeah, doing a board meeting once every few months isn't that hands on, if you will. But it's more than what Berkshire does or used to do.
We've talked quite a bit about holding discounts on the podcast and in several articles. So, why do these holding discounts exist? And to add to my question, why are holding companies sometimes more interesting than investing in the company itself? For example, some of us own the holding company Proces. You're probably familiar with it.
Yeah, we own it as well.
Yeah, you're basically buying Tencent with a discount. I just looked at fiscal AI. If you bought the company somewhere in 21, Tencent, you would get a 7% return, and Proces returned almost 50%. So you can see the discount lowering here. It's getting smaller. Maybe to simplify my question, what is why are there holding discounts, and why are holding companies potentially interesting investments?
So you could basically view a holding company discount as the holding company variant of what you normally would see as a price earnings or a price cash flow metric, right? I mean, in the end, it shows how much are people willing to pay for a for the portfolio of the company. So a company with a discount of 30% could be very expensive, and a company with a discount of 10% could be very cheap, depending on the track record of management. So as we're speaking, Investor AB has a discount of 10%, but there aren't that many companies that are able to generate 12% or more per annum since 1919. So you could say to some extent it's justified that they have a lower discount because the strategy has proven itself, the management has proven itself, and so you demand a lower discount for owning the company. Whereas with Proces a couple of years ago, it might be a good example. On top of having, let's say, China-specific risks, there were also the concentration in one company, which was an issue. You had at that point in time still a very significant detraction from the non-Tencent activities, which they've turned around by now. So now there are a few things in place that I would say justify a lower discount than 50% or something, which it was a few years ago. There were also some technical factors, of course, when they were listed in South America with the holding company Naspers, and then they were so large in the local market that basically pension funds were forced sellers, which artificially inflated the discount. So, I mean, that was a specific opportunity, I would say, at the time of the listing of Proces in the Netherlands, that they created a vehicle, and now they've also optimized the non-Tencent portfolio. And now you could see the management team, ironically enough, since Bob van Dijk left, has you could say optimized the company a bit, and so now a lower discount is justified. But you still have China specific risk. You still have concentration risks. So you could say Prosus still deserves a discount of maybe 20% versus an Investor AB where you're investing in companies listed on markets in Sweden, Switzerland, the US, different rule of law, different markets, a more pro business shareholder base. But there are holding companies with a 60% discount. They have only destroyed value over a 5, 10, 20, 30-year period. So the only role for the holding company to exist is basically so that the nieces and nephews of the founders have something to do and get a good salary, get a nice gets yeah. It's literally it's nepotism at its highest form. So you really have to be vigilant in terms of which companies you're buying and what are the metrics that you're looking for. So that's why we say 80 to 90% of companies in our universe, whether that be a holding company or a serial acquirer, is automatically it's automatically discarded because the metrics that we're looking for, the most important things aren't there. And having a high discount, no, the typical value investor would say, oh, it's a high discount, so it's very cheap compared to the sum of the parts. But you're not going to realize the sum of the parts unless there is a breakup or unless the company is privatized. So you had like a Spanish holding company, Corporación Financiera Alba. The March family just delisted it, and so you had a very once in a lifetime a huge jump in the share price because at some point the significant and consistent discount was closed. But apart from something like that happening, um, you need the management team and the founding family to close the discount, and the only way you're going to do that is by showing that you create value. And I always use an example of a French company. It's Peugeot Invest. It used to be Group FFP, and so the Peugeot family basically used that as a vehicle to run their portfolio. And so the largest position by far was Peugeot. Now it's Stellantis after the merger with Fiat Chrysler, and they started investing in private equity. They started investing in real estate, both public companies and private companies. Well, they invested in Orpea, which has been kind of a disaster. So that was a over 90% drop in value. They had a private portfolio of real estate companies or the real estate developer, which went bankrupt. So they've had a lot of destruction of value in the non-Peugeot companies, and then you have a core holding company, a core holding, which is a highly cyclical car business. So just in terms of the structure, we don't like those assets, so we wouldn't buy it. The company has destroyed value in terms of errors of commission, significant errors of commission in terms of the companies that they've bought, either listed or private. And then on top of that, you have nepotism of its highest form in terms of if a family wants a high income, you could pay a dividend and all shareholders benefit from that. But what the Peugeot family did is they said, oh, there's no listed company anymore which carries the name Peugeot, and isn't that a shame? We would like to have a listed company that carries the name Peugeot. So you have their holding company, which was ran by and is controlled through the board by people of Peugeot. It's still the case, by the way. And they decided that the Peugeot family should get a license fee for using the name Peugeot. So as an outside shareholder, I would say, I don't care what name you give the company. For all I care, you call it Core Holding Company SA, and you leave it there, or you keep the name Group FFP. I don't mind as a shareholder, but you're extracting resources from the holding company in favor of the family. I mean, a clearer form of misalignment of interests, I can't think of. And there are a couple of holding companies in France that haven't been able to create value for a long time. And then you say, well, they have a very big discount. Yeah, but if you don't create value, then you could say the discount is justified. Similarly to I would say a regular company destroying value. Yeah, well then as a manager, why should you earn a high price earnings multiple? So that you could see this as the variant of that in a holding company.
So, what you're saying is that a holding discount correlates to the quality and opportunities of the businesses it's invested in, sort of, and a high discount can be expensive and a low discount can still be cheap.
Yeah, and then you have companies where, of course, some of the components of the balance sheet are considered to be too cyclical or too sensitive. The best example I can give is Brookfield Corporation, the holding company on top of Brookfield Asset Management. So they own Oak Tree, which everyone knows maybe from Howard Marks. Particularly in the Netherlands, they own the high tech campus where ASML is located, for instance. You have all these kind of businesses, but two very important components of the sum of the parts are, on the one hand, the shares of carried interest, so basically the performance fees, their share of outperformance in the funds that are managed by Brookfield Asset Management on behalf of their clients. So they say we have a hurdle rate of 15 to 20%, and if we exceed it, then we get, depending on the fund, a percentage of that outperformance. That's a pure profit for the company basically. But in terms of market turbulence, people are saying, well, it's going to be problematic to realize this on a short term because there will not be an exit for a private equity portfolio in terms of an IPO or a sponsor buying it, a strategic investor buying it. So investors were discounting the carried interest on the balance sheet of Brookfield, which is a very significant component. And then Brookfield Asset Management, of course, is also discounted because they will probably earn less carried interest as well on their behalf and less fees from IPOs and these kind of things. And then another point is they own a big real estate portfolio. And when interest rates are low, real estate is valued very highly. And then when interest rates are high, real estate could be in trouble. So especially office real estate, and you saw that in the COVID period, office and retail real estate, so shopping malls, was under pressure a lot. So basically, you could get both the real estate portfolio and the carried interest on the holding company level for free by buying the holding company. So we see a normalized discount range between 25 to 35% for Brookfield. You could buy it at 50 to 60% discount at the peak of the volatility there. So that was just investors pricing in, throwing away the baby with the bathwater. And then a lot of the real estate that Brookfield owns are iconic buildings. And I mean, after a while, markets are going to normalize again. So they will realize the carried interest at some point. So it's not you're just postponing those earnings to a later event, but it's not like it's never going to happen. So those are always moments where we think, hey, this is an interesting company to buy the assets, and in terms of market turbulence. So that's where a discount can be elevated for a short period of time, which can actually offer a buying opportunity. So a similar situation happened in February to April, if you will. We started buying into Alphabet, the holding company of Google. And at some point, everyone was saying, well, the DeepSeek moment. So every Western company in working in AI was suddenly sold off very, very arbitrarily. And then you got the Trump tariff tantrum in April, where every company or every country was getting tariffed, where even an island with penguins was very very shocked that that happened. So every investor it was like a very strong sell-off as well. So that was a moment where we started buying for clients. We started tactically increasing positions in Alphabet, positions in companies like Brookfield, because we saw that the discounts were were much higher, and at some point investors were pricing in that Google search was never going to happen again, and never or was never was didn't have a future. While we're still, even though search traffic is going to OpenAI's ChatGPT, um, you still see a lot of people that are actually going back to Google because now they're integrating AI overviews. I saw that on my phone. I have a Samsung Big B, which is horrible. Was replaced by Gemini, Google Gemini, and you see that a lot of people that are using ChatGPT are actually going back to Google, switching to Gemini because they think that the user experience is better there. Still, a lot of people are doing classic search. So I mean, is it a zero? Well, you could say compared to history, you could add a lower multiple to it, but people weren't valuing, I would say, the cloud business properly, weren't valuing the YouTube business properly, weren't ascribing any value to Waymo or other bets. So in our some of the parts of Google, or of Alphabet, that was a very interesting moment where, like, hey, people are throwing the baby out with the bathwater, in in February, and then in April, everything was being sold off, particularly U.S. listed companies. So yeah, that was also a moment where we were very interested in adding to those businesses.
I think it's also about habits. People are driven by habits. Google is a habit. I think AI, in a way, and not to go off topic here, but I think AI will just increase overall volume, and I think it can also increase just overall search volume. People will start looking up more stuff, and yes, lots will go to ChatGPT and Gemini and other services, but I think lots of that will probably still go to Google. And the question is just how well can they still monetize that, since it is still their cash cow. But like you said, they have many, many other very interesting parts of their business that are doing quite well. So, what are some of your favorite holding companies? Perhaps a couple well known names. You just mentioned Alphabet, Brookfield, and perhaps a couple lesser known names for people that are interested in looking at them.
Yeah, sure. So holding companies or serial acquirers or both, or
Yeah, just throw out a couple names, and maybe I know a couple, but I'm always looking for interesting names too. So,
well, I would say some of our top positions are, and have been for a while, Constellation Software and Investor AB. So those have been around for the most part of the strategy, for instance. So they've had a very good contribution. In the Netherlands, Process is well known, which we already touched upon. A bit lesser known, you could say, is MBB, a German holding company. They have a very interesting portfolio of, you could say, about 300 million in cash and large cap equities, and then they own about over 800 million euros of worth of shares in a German infrastructure company. So they are very important. One of the three or four top players in terms of both underground pipelines for gas infrastructure. So both classical gas, but also LNG, and putting connecting the LNG terminals to the regular gas network, which is of course for particularly Germany a very important market, and for also underground pipelines for electricity. So Germany said we don't want these pipelines on top of our over people's houses. We want them underground, and they are one of the few companies that are able to do that. And I think what is very interesting, MBB was able to buy into the company for around 20 million euros, and then they did an IPO at about 1 billion 2 years later.
not bad.
So that was an insane return. That's where a lot of the cash comes from. And so that's most of the business that's public, and then a private company I think is very interesting, is one of the bigger players in Germany in terms of cybersecurity, which is called DTS. which is unlisted. And recently, despite having a very significant increase year to date of close to a total return of close to 70% if you add the special dividend to it, we still think it's very undervalued compared to just the sum of the parts of these companies that we just mentioned. So MBB is a lesser known holding company, and maybe in terms of a serial acquirer, Chapters Group could be an interesting name, or TerraVest, two companies. For TerraVest, we have a write-up on our website, tresorcapital.nl, and we have one will be published soon on Chapters as well, which we also already published in our weekly newsletter for clients and people who are interested in that. So those are some names that we've that are lesser known, I would say, but also very very interesting still, even at these levels.
Yeah, I know most of them. I think you went to Chapters Group a couple months ago, right?
Yeah.
And I've read a couple write-ups on TerraVest. MBB is new for me, so that is interesting to take a look at. Let's work towards an ending of this episode. I think we both need to get some dinner later, so I just have a couple short questions, and we'll end it. We haven't really touched on valuation. We talked briefly about the net asset value for holding companies, which I think is probably the most obvious way of looking at the valuation of a holding company. For a serial acquirer, some of these companies usually look optically quite expensive, especially if you look at like earnings ratios, right? Due to accounting standards. Is there a framework you use to assess them differently, or how do you value a serial acquirer usually?
Serial acquirer is usually a combination of either a sum of the parts or a pure DCF. So DCF just for a pure play serial acquirer. But for Constellation, for instance, they have two listed companies. So we just take their share of the market value of Topicus and Lumine. And then we do a DCF of the non-listed components. So basically the standalone Constellation Group. But in general, we just use a discounted cash flow method to value them, and we try to be a bit conservative. So we look at a much lower price to cash flow ending multiple than the current market multiple. So we automatically price in some multiple contraction over time to get a bit of a depression, if you will, on the valuation there. And then we have scenarios with a bit more conservative assumptions, so that we don't get too optimistic. But when you're paying a multiple of 25 times or 30 times today, that could be depending on the growth rate, that could be a market multiple or a lower than market multiple in 2 or 3 years time. So it also depends on your investment horizon. If you're owning a company for a year, then paying too high a multiple might be problematic. But again, to add maybe a quote by Charlie Munger, which is all saying, he said that at some point over the long term, it's hard for a stock to earn a better return than the business which underlies it. So if the business earns a 6% return on capital over a very long period, like 30-40 years, and you hold it for that time, then it's very hard to get much more than 6%, even if you paid a very low multiple. And then conversely, inverting that, if you a high multiple, but the company earns, let's say, 15 or 20 or 25% returns on their capital over that period, then that's going to be the main driver of your return as a shareholder. So it's very hard to get a different return than that 15 to 20% if the company earns that. That is, of course, on a very long-term basis. So, I mean, you do have to be mindful. Don't pay maybe 60, 70, 80 times cash flow.
What about 600 times earnings for Palantir?
Yeah, I was just thinking of Palantir. So don't. I wanted to say don't pay 100 times revenue or 600 times earnings. That's
Yeah, 100 times revenue.
um yeah. I mean, it's just very hard to see you making money there. So I mean,
You can in the short term, right?
yeah, you can in the short term. I mean, especially momentum is a very strong force in the market. So it's very hard if you're a contrarian and you think, hey, it's interesting to buy into Alphabet in February, and then you see the price is pushed even lower after the Trump tariffs, for instance. But now we're back at around 200. So I mean, for the A share. So I mean, it's depending on your horizon. If you're buying a company for if your investment horizon is 1 year or less, doing anything other than being in a cash or a bond like security, I would say is speculation. So I would advise you if a client comes to us and says, "Oh, I want to make some money in the next 6 months," I said, "Well, you might as well go to the casino because your odds aren't going to be that much different. You never know what tomorrow will bring on the stock market, but a rolling period of 10 years where you have made a negative return in equities, and especially in these top tier equities, is very hard to find." So yeah, that's a point I would say there.
Yeah, I think that's great advice. It's you briefly mentioned momentum. I think it's one of the reasons I absolutely hate shorting stocks. First of all, you can only earn like a 100%, right? So you can double your earnings. But besides, I mean, let's say you're shorting Palantir. I think you're very likely to be right, but who knows whether that's going to be 6 months, a year, 5 years, 10 years, right? So yeah, momentum is a strong force.
I think Peter Lynch said you can be the market can be irrational for much longer than you can stay solvent. So I will just end my thoughts on shorting there.
I always like to end with your best piece of advice to investors. It can be anything, but something you wish you knew much earlier or starting out. So, what would be your best piece of advice to our listeners?
Something that is still underestimated, even by me and by our company, to be honest, is the power of incentives. In the end, everything is going to be driven by what you're paid to do in an organization. So incentive informs culture. Culture informs the very long-term returns that you can make as a shareholder. If you're incentivizing on revenue growth and an absolute number of revenue growth, you're going to buy everything, no matter if it's a negative net present value equation. If it destroys value, but you earn a bonus for doing it, then you're in the end you're just going to do that. So from the very top level of the organization to key decision makers lower in the organization, I would say incentive structures is the number one thing that you need to look at, and a combination of that with the importance of skin in the game, I would say partnering with good management teams that have a large part of their own personal wealth invested in the company, whether that's 1 million for a small cap or 10 billion for a large cap. 10 billion can be a small stake, while 1 million can be a lot of money depending on the company. So that those are the I would say the most important things to look at.
That's a great note to end on. Thank you so much for coming on the show, Michael. I hope we can do something like this again sometime. It was a lot of fun, and we really do appreciate you taking out the time to talk with us. So thanks.
Always fun to talk about investing. So thank you very much for your time, for listening to my ramblings on these kind of companies.
I love your ramblings. I wouldn't have asked you any other way. Before we go, is there a place people can reach out or find or learn more about you or the fund or
Yeah, so I'm always active on X or Twitter. So that's at Michael Gielkens, which is just my first last name. And I try to tweet some interesting stuff there on markets or on especially on holding companies and serial acquirers. I would say an especially useful resource could be our newsletter, which is free. And every week it's if you copy and paste everything into a Word document, it's often exceeding 30 pages on a weekly basis. So you have to be a nerd if you want to read everything. But yeah, we try to give our view on markets, but especially on these kind of companies. So it's a deep dive. It's news facts on holding companies and serial acquirers, and often a short write up or an investment case, and that can be approached via our website tresorcapital.nl.
Is that in English as well?
It can be translated, but we are working on. We currently use Mailchimp, and we are looking to migrate to a platform in a couple of weeks at the latest, which automatically builds in a translation function, at least into English and maybe a second language. So maybe people can reach out to say which language they prefer, whether that's German or French or Spanish.
Chinese?
Yeah, Chinese. Well, you never know. So
A billion people, right?
the Chinese capitalists.
Yeah, but for our listeners, I mean, nowadays you have so many AI tools, just copy and paste it in ChatGPT and you'll have the translation mostly correct. I'll make sure to put all the links in the show notes and in the description. So once again, great talking to you, Michael, and see you next time. Thanks.
Thank you.